The recent surge in demand for gold and silver reflects their growing appeal as safe haven assets amid heightened economic and geopolitical uncertainties. Gold, in particular, has reached near record levels as investors seek stability during turbulent times. Political events, such as the closely contested U.S. presidential election, have added layers of unpredictability to the market, influencing investor behavior. With major shifts in policy and fiscal priorities expected, there's a heightened demand for assets that can preserve wealth despite potential economic volatility. Alongside political uncertainties, ongoing geopolitical tensions, especially between major global economies and within key trading regions, further drive demand for safe assets like gold and silver, as these metals historically provide protection against financial and geopolitical risks. In parallel, central bank policies, particularly the U.S. Federal Reserve's recent decisions to keep interest rates low, create favorable conditions for precious metals. When interest rates are low, the opportunity cost of holding non-yielding assets like gold diminishes, making it an attractive choice for preserving value. This trend is further supported by growing inflation concerns, driven by factors such as supply chain disruptions, expansive government stimulus packages, and rising global commodity prices. Inflation erodes purchasing power, which strengthens gold's role as a hedge for maintaining wealth over time. Moreover, fluctuations in the U.S. dollar heavily influence gold prices. As the dollar weakens, gold becomes more affordable for international buyers, boosting global demand. Silver, while also serving as a safe haven, benefits from strong industrial demand, especially in green technology sectors. In this climate of economic uncertainty and shifting monetary policy, gold and silver emerge as robust options for investors seeking to diversify their portfolios and protect their purchasing power, reflecting their enduring role as preferred assets in volatile markets. The Federal Reserve's ongoing policies, particularly its commitment to keeping interest rates low, play a critical role in strengthening gold's appeal as a safe haven asset. Historically, precious metals like gold perform well in low interest rate environments because the opportunity cost of holding non-yielding assets diminishes when compared to lower returns on traditional investments, such as bonds or savings accounts. As inflation concerns mount, the value of holding assets that preserve purchasing power over the long term becomes increasingly attractive. By setting a low interest rate, the Federal Reserve effectively encourages borrowing and investment, but it also diminishes the appeal of traditional saving mechanisms. This dynamic pushes investors to explore alternative assets like gold and silver, which are seen as reliable stores of value in uncertain economic climates. Further complicating the landscape, inflationary pressures continue to build due to a variety of factors, including government stimulus spending, supply chain disruptions, and rising global commodity prices. As the cost of goods and services increases, many investors grow wary of holding cash or cash-equivalent assets that lose purchasing power over time. Gold, as a physical asset with intrinsic value, has historically been a popular hedge against inflation, offering a way to preserve wealth even as fiat currencies face depreciation. Silver, though often overlooked compared to gold, also benefits in this scenario, with its price often closely tracking gold's movements in inflationary periods. This economic climate, characterized by low interest rates and rising inflation fears, creates a favorable environment for precious metals. Investors who are seeking to protect their wealth from the erosive effects of inflation view gold and silver as effective tools. The Federal Reserve's policies, aimed at sustaining economic growth, inadvertently heighten the appeal of these metals, reinforcing their position as essential components of a well-diversified portfolio. As long as the central bank maintains this stance, demand for gold and silver is likely to remain robust. The U.S. dollar's role as the world's primary reserve currency is increasingly under scrutiny as countries around the world begin to reevaluate their reliance on it for international trade and reserves. This shift, often termed de-dollarization, has gained traction among various nations seeking to reduce their vulnerability to fluctuations in the U.S. economy and its political decisions. A prominent factor driving de-dollarization is the perception of the U.S. dollar as a tool for advancing American geopolitical interests. In recent years, the U.S. has used financial sanctions and other economic measures to influence foreign policies of other nations, sometimes freezing assets held in dollars or restricting access to dollar-based financial networks. While effective as a policy tool, These actions have led other countries to seek alternatives to lessen their dependence on a currency that can be subject to such controls. BRICS nations, Brazil, Russia, India, China, and South Africa, in particular, have been at the forefront of this movement, striving to increase the use of local currencies for trade within the bloc. China, the world's second-largest economy, has been especially proactive in promoting its currency, the yuan, as a viable alternative to the dollar. Additionally, countries in the BRICS alliance have made efforts to establish new payment systems that facilitate cross-border transactions without needing the dollar as an intermediary. These steps are part of a broader strategy aimed at enhancing economic sovereignty and reducing exposure to dollar-based risks. This transition holds significant implications for global trade and finance as the dollar's dominance begins to wane. With the dollar gradually losing its position as the default reserve currency, the demand for stable alternative assets like gold has risen. Central banks in these de-dollarizing countries increasingly turn to gold as a hedge against currency risks and to diversify their reserves. This shift not only reduces reliance on the dollar, but also underscores gold's role as a trusted store of value amid changing global financial dynamics. The growing trend of foreign central banks purchasing physical gold as part of their strategic shift away from the U.S. dollar highlights a significant transformation in global financial dynamics. This movement is driven by concerns over the U.S. government's increasing weaponization of the dollar, particularly as the currency is being used for political purposes, such as sanctions and freezing foreign assets. This has raised fears among foreign governments about the stability and security of holding large reserves in U.S. dollars. The recent example of the U.S. seizing Russian assets during the ongoing geopolitical tensions has underscored these concerns, sending a clear signal to other nations that the dollar is not as secure a store of value as it once was. This has prompted many countries to seek alternatives, and gold, as a non-currency, has emerged as a preferred safe haven asset. For the past several years, foreign central banks have been net buyers of gold, and this trend is expected to continue. The appeal of gold lies in its historical role as a stable store of value, unaffected by the political decisions or economic crises that can impact fiat currencies like the U.S. dollar. As a result, many countries, particularly those in the BRICS alliance, have increased their gold reserves, viewing it as a hedge against both inflation and the declining purchasing power of the dollar. Central banks have recognized gold's resilience during periods of financial instability, particularly during times of crisis when currencies tend to lose value. This growing demand for physical gold is reshaping the global monetary system as central banks now increasingly diversify their reserves into this precious metal. As more nations move away from dollar-based assets and seek alternatives to protect their wealth, the role of gold as a trusted, long-term store of value is solidified, and its importance in international finance is expected to grow in the coming years. This shift also represents a broader push for a more multipolar world economy, where assets like gold take on greater significance in the global financial landscape. The increasing trend of dollarization, where countries and central banks move away from using the U.S. dollar in international trade, marks a significant shift in global finance and has profound implications for the future of currency markets and the global economy. For decades, the U.S. dollar has been the undisputed global reserve currency, dominating international trade, finance, and foreign exchange reserves. It has been used for a vast majority of global transactions, particularly in commodities like oil, gold, and natural gas. However, the rising inclination of many countries, especially those in the BRICS like Brazil, Russia, India, China, and South Africa, toward reducing their reliance on the dollar signals a potential rebalancing of the global financial system. One of the most significant catalysts for this trend is the increasing use of the U.S. dollar by the U.S. government for political purposes, such as the imposition of economic sanctions and the weaponization of financial instruments. The U.S. has used its dominant position in the global financial system to advance its foreign policy objectives, freezing foreign reserves of countries it is in conflict with or imposing sanctions on nations like Iran, Russia, and Venezuela. For instance, the U.S. government's decision to freeze $300 billion worth of Russian assets in the wake of Russia's invasion of Ukraine has sent a powerful message to the rest of the world that the U.S. can use its control over the dollar to harm the interests of other nations. This has caused many countries to reconsider the safety of holding large amounts of U.S. dollar-denominated assets, particularly in light of geopolitical tensions. The fear of the dollar being used as a tool of political leverage has pushed several countries to seek alternatives. The BRICS nations, in particular, have been at the forefront of these efforts. These countries are increasingly turning to their own national currencies for trade and investment, as well as using other forms of payment, such as the Chinese yuan. The shift is most evident in commodity transactions, where the U.S. dollar has long been the standard. Countries like Russia and China have moved to settle energy deals using their own currencies, bypassing the U.S. dollar altogether. China, for example, has also sought to use its currency for the settlement of oil trades, challenging the long-standing dominance of the dollar in the energy markets. The move away from the U.S. dollar is facilitated by the development of alternative payment systems and platforms that enable countries to engage in trade without relying on the dollar. For instance, China has rolled out the Cross-Border Interbank Payment System, CIPS, which is seen as a competitor to the U.S.-controlled SWIFT system. This system allows for the settlement of international transactions in Chinese yuan, making it easier for countries to engage in trade with China and other partners without using the U.S. dollar. Similarly, Russia has developed its own alternative payment systems to circumvent the dollar-based financial infrastructure. As a result, the demand for the U.S. dollar in international trade is slowly diminishing, which could have long-term consequences for the dollar's position as the world's primary reserve currency. The decline in the use of the dollar, especially among emerging economies, is reshaping global trade dynamics. As countries reduce their exposure to the U.S. dollar, they are turning to other assets to preserve their economic security. One of the key beneficiaries of this trend is gold. As the world moves away from the dollar, countries are increasingly turning to gold as a safe haven asset and a store of value. Gold has long been considered a hedge against currency devaluation, inflation, and geopolitical instability. In times of financial uncertainty, gold provides a tangible asset that holds value regardless of fluctuations in fiat currencies. For many nations, particularly those in the BRICS bloc, gold serves as a way to diversify their reserves and protect against the risks associated with holding large amounts of U.S. dollars. Foreign central banks have been major buyers of physical gold in recent years, with gold purchases hitting record levels. According to reports, central banks in emerging markets have been actively adding gold to their reserves as a way to protect against the depreciation of the dollar. In fact, for several months leading up to 2023, the largest buyers of gold were not retail investors, but foreign central banks. This trend has been most pronounced in countries like China, Russia, and India, who have all significantly increased their gold holdings. By shifting their reserves into gold, these countries are effectively reducing their exposure to the U.S. dollar while also benefiting from gold's historically proven role as a store of value. In addition to central banks, individual investors are also showing increased interest in gold as a way to safeguard their wealth in an increasingly uncertain global economic landscape. The rise in inflationary pressures, economic instability, and rising interest rates in many parts of the world have made traditional investments, such as government bonds and equities, less attractive to investors. Gold, however, remains a popular choice due to its inherent stability. The allure of gold as a hedge against inflation and economic risk is pushing both institutional and retail investors to turn to the metal as a more secure investment option. As the trend of dollarization continues to gain traction, it is likely that gold's role in the global economy will continue to grow. Central banks are likely to continue increasing their gold reserves as a way to mitigate the risks associated with the U.S. dollar, while individual investors may look to gold as a reliable store of value in an increasingly volatile financial environment. This growing demand for gold is reshaping the dynamics of the precious metals market and could signal a shift toward a more multipolar global financial system, where the U.S. dollar is no longer the central player. Gold's enduring value and its role as a hedge against uncertainty will likely make it a critical asset in the coming years as countries and investors seek to protect their wealth from the risks posed by fiat currencies and the fluctuating dominance of the U.S. dollar.